Good evening, ladies and gentlemen. I would like to once again welcome you all to First Capital Investor Symposium 2026. So the theme that we have picked this year relates to our stance that economic indicators may soften, which in turn may rekindle debt sustainability worries. So, the underlying assumptions on this theme, as well as the broader narrative behind this, together with insights on how to tackle this reality as investors, will be presented by my colleagues Ranjan and Shahana. What I will take you through is First Capital's track record, which is a depiction of how accurate or inaccurate we have been in the forecast that we did for 2025. So this is the criteria that we use to assess accuracy. We have 5 levels: accurate, mostly accurate, partly accurate, and then we have the lowest 2 rungs, weak accuracy and inaccurate. So without further ado, let's move ahead and see how we have fared in our forecast for economic indicators. So we've looked at 6 key indicators here, out of which 2 we have forecasted accurately. That's tourist arrivals and foreign reserves, which we came very close to in forecasting. And then we have forecasted 3 indicators within the mostly accurate range. And I must also point out that worker remittances as well as private sector credit growth surpassed our forecast, even though we came quite close when we put forward our numbers. In terms of inflation, which we once again forecasted in a mostly accurate manner, I think where we deviated mostly from the actual numbers was during the first couple of months of 2025, where we saw a steeper than expected level of deflation. And as you can see, during the remainder of the year, our forecasts have been largely on par with the actual numbers. And then we have earnings from tourism, the only economic indicator that fell within the range of partly accurate. Even though we got the tourist arrivals number on par with the actual figure, how did this happen? So what happened predominantly last year was there was a sort of shift in the demography of the tourist pool that arrived in Sri Lanka, which plausibly led to per tourist spending inching down, which is why we have sort of consistently overestimated the earnings from tourism to be in line with the tourist arrival figures. Moving ahead, let's look at our fixed income outlook and how we have fared. So in January 2025, taking into account the macroeconomic fundamentals and the broader economic reality that prevailed, our stance was that bond yields would see some upward pressure starting from the middle of 2025. However, now we know that this did not hold true. Taking into account what happened towards the latter part of January and through February, we sat down and took another look at things. And we ended up tweaking this initial outlook where we pushed the expectation for upward pressure on yields to the very latter part of 2024. So now we know that this we forecasted accurately. However, what happened after March, predominantly in April, May, and June? We saw bond yields sort of consistently adjust downward. And this was also fueled by a rather surprising rate cut that came in May. So taking this reality into account, we once again tweaked our assumptions in July 2025. What we said at the time was that we expected bond yields to remain largely stable within the next 6 to 12 months. And as you can see, we were right, but only up to November. In December, a bit contrary to our initial view, what we saw was slight upward pressure on bond yields. So once again, this has warranted us to relook at the fundamentals and the forces behind this trend. And we once again tweaked our outlook, which I believe will be presented by Ranjan. Let's move ahead and see what our outlook for policy rates was. Once again, we managed to forecast it in an accurate manner. We expected policy rates, or the OPR, to remain stable or unchanged through 2025. This was true except for one instance in May, where the central bank introduced a policy rate cut of 25 basis points, which we can all agree that we did not see coming. Then we have bank rates, or the AWPR, that's the average weighted prime rate. We have forecasted it in a partly accurate manner. So at the beginning of 2025, the range we forecasted for the AWPR was one between 10% to 12%. So even though we expected the AWPR to hover within this elevated range, as demand and capacity to lend to the private sector kept sort of persistently accelerating, what happened on the other side was that we saw credit to the state shrink. On top of that, we also saw the OPR being cut by 25 basis points, which then led to the AWPR sort of consistently remaining below the initial threshold of 10 to 12% that we forecasted. Since then, in July, we tweaked our forecast, and the new forecast stood at 7.5 to 8.5%, which has largely been accurate. Moving ahead, we have the exchange rate. This we forecasted accurately. The range that we had for 2025 was largely between 305 to 310 rupees, and this was actually an expected depreciation. The forces behind this was the resumption of private vehicle importation, the external debt repayments that we had in the books for 2025, as well as the persistent and almost aggressive purchase of USD that the central bank conducted throughout 2025. So finally, I think as Dilshan also mentioned, we have our outlook for equity, which we once again got in a partly accurate manner. Our forecast for the ASPI for 2025 was 18,500, which the ASPI sort of overshot in July or August in 2025. So the main reasoning behind this as to why our forecast was lower than the actual figure that came through was because the interest rates as well as inflation remained consistently lower than our initial expectations, which drove the momentum in the equity market, and also the strong corporate earnings that came in, which in turn reinforced investor confidence, further falling and boosting the ASPI. So ladies and gentlemen, that brings us to the end of my section. Let me now invite Ranjan to take you through the next bit of our presentation. Thank you so much.
Hello everyone. So with Akna taking us to the track record, let's move on to the story. But before we move on to the story and the outlook for 2026, I want to share a quote with you, every one of you. The quote is from an American economist and a Nobel Prize winner, Joseph Stiglitz. What he says is, austerity is self-defeating. It weakens growth, and weak growth makes debt problems worse. These words from the economist correctly highlights the current Sri Lanka trajectory, where we are looking at a slow growth coming into this year. But before we move on there, let me tell you the progress that we have made so far. And Sri Lanka had made tremendous strides in this front. So, starting off from, we have seen inflation cooling down. And we have seen external pressures easing, and the investor confidence is slowly returning back. All these things we achieved is through fiscal discipline that we followed in 2025 and before. But however, going forward, we think that this is not going to be enough. We think that reforms is crucial. And to move forward, let me tell you this story now. So to start off with, we look at the political stability. So we had two elections in 2024, which were critical to Sri Lanka. One was the presidential election, followed by the parliament election. Both, we saw the governing party win the majority. And in 2025, we had the local government election, where the governing party again secured the majority seats. So through all this, what we have seen is clear political direction and consistent investor confidence that's driving the markets and the economy. Then we have seen consistent engagement to the international communities, which has been very positive as well. But something that we are still seeing in a slow movement is the policy reform, where we think that much can be done in the next few years. Considering all these factors, we have continued to maintain our stance on the political front at low risk. Now, with political front discussed, let's move on to the economic side. So on the economic side, we think and we maintain our view where we think the risk factor is at medium-low risk levels. Starting off with economic growth, as Akna also correctly mentioned, we expect GDP growth to be fair between 3 to 4% for 2025 and 2026. And this is somewhat of a bit of a slowdown coming into 2025, where we are expected to see a growth of around 5% for the full year. And why this growth is slowing down, let me highlight from here. So, with growth slowing down, one factor is considering is the private sector credit growth. So we all know that last year, Sri Lanka had a large private sector credit growth, where private sector credit growth grew by around 26%. While on the other side, we saw state sector credit coming down. But looking forward, we think that the coming year, we can see private sector credit moderating to about 18% levels. So a couple of factors are contributing to that. One thing is that we are expected to see AWPR slowly inching upwards. And on the other side, we will see the pent-up demand that we had for vehicles in the last year start to get slowed down. And this is also expected to add a bit of pressure to the private sector credit. But something is changing this year. That is the state credit side. So last year we saw a contraction of 3%. But this year, from the research front, we are expecting state credit to grow by around 2%. The main reason is because we think that with the impact that was created from the cyclone Ditwa, the damage that caused to the infrastructure, there needs to be some rebuilding that comes from the government side. So this rebuilding is going to come through private in terms of credit, and that's why we are expecting state credit to grow. But something to note here is that when you look at the past trend, what we have seen is that when debt to GDP crosses the 50% mark, we see pressure coming into the system. But something to note here is we are not seeing that pressure coming because of the fact that mainly we see private sector credit moderating in 2026. Moving forward, inflation is edging up slowly. But based on our forecast, it is not expected to reach the central bank target of 5%. On the other side, we have liquidity. So liquidity also expected to be constrained with a bit of asymmetric between the banking system. Then the third factor that is limiting growth is the reduction in growth in the private consumption. So we all are feeling right now the reduction in private consumption. So when you talk with the society, what we are feeling is that a lot of people has been burdened with taxes and their disposable incomes are coming down mainly because of the tax front. And now with the inflation going up, it is expected to further contract. And this is expected to put a bit of pressure on consumer front. And this is why we are expecting the GDP also to get impacted from this. Next, looking at the external front, we expect external front also to add a bit of pressure to the GDP, with imports starting to gather pace in the near term. And while on the other side, we are seeing exports also slow down. Coming back to imports, Imports is expected to pick up mainly because of the construction activities that is going to come after the impact that from Cyclone Ditwa. Because as you all know, construction sector relies a lot on imports. And with the rebuilding effort that's going on, we will see imports picking up. But from the other side, we have been dealt with multiple blows. That is, on the other side, we are seeing the export side also slowing down. That is partly coming off from the global slowdown that we will see. So combine all of this together, we may see the trade deficit also starting to slowly expand, and that is also putting up adverse pressure on the GDP. Although trade deficit is increasing, the current account is expected to stay afloat, and that is thanks to two main factors. One is remittances, the other one is the tourism. In terms of remittances, last year we had the highest growth in terms of remittances, and it was a record. And going forward, we expect remittance flow to increase further, but the growth is flowing is expected to slow down. And in terms of tourism, as Akna correctly mentioned, we are seeing a bit of a change in demographics, where previously we saw number 1 and 2 spots being China and Europe, who were like the big spenders. But now, India is still number 1, but the Russia is coming into the number 2 place, where we are seeing a bit of spending coming down. And in terms of demographics also, we are seeing a bit of change in the age mix also that is coming to Sri Lanka. So previously what we saw was that a lot of tourists are coming between the age of 30 to 40 who can spend a bit more. But now we are seeing that pattern change a bit, where mostly it's the 20s and 30s coming who are mostly into adventure and backpacking. So that's why we are seeing tourism earnings growing, but not growing at the optimum level. And something to note is that the record year we had for tourism earnings was 2018, and that target is expected to be only achieved in 2027 based on our forecast. So all these factors combined, we are expecting reserve accumulation to remain slow. So when I talk about reserves, for 2026, we are expecting 7.25 billion in terms of reserves, and for the following year, we are expecting 7.5. And you may ask why we are expecting such a slow growth figure when the IMF targets is at around 8 billion for next year. Mainly, it's coming from three factors. One thing is we may see the rupee depreciating, adding a bit of pressure to ability for the central bank to purchase dollars. On the other side, we will see the trade deficit widening, and that can also put adverse pressure on central banks' dollar purchase operations. Then something coming up is also the debt repayment factor that is also creating adverse pressure on reserves. Then coming on to BOP is expected to weaken, as I mentioned. So coming off from the trade deficit to the slowness that we will see in the export side, everything is going to translate into BOP as well as the the debt repayments. And but something that keeping the BOP on positive levels is the inflows that I have highlighted on this side. So talking about BOP and talking about debt maturities, I think this is an interesting topic that we may have to look at in the coming months, years. So 2025, in terms of the local and the ISB debt maturities, was one of the lowest years, where Sri Lanka only had to pay about 1 trillion rupees in terms of local and ISB maturities. But stepping into 2026, the maturities are expected to gather pace. And as you can see here on the quarterly outstanding bond maturities, first quarter itself is adding a lot of pressure on the operations. Then in terms of the ISB payments are more or less stable, where we had to pay about $336 million for 2026, and it's due in March. Then let's look at the fiscal side of things. So we'll look at the GDP and how things are going to get affected. And now moving on to fiscal, we think that fiscal discipline will continue moving forward. But there's going to be a challenge this year. That is gathering up the revenue from compared to last year. So all of you know that last year Sri Lanka generated about 900 billion rupees from vehicle taxes. So now with the pent-up demand slowing down, it is going to be difficult to gather up that revenue and fill up that hole. But something is there that is there in the horizon. That is digitalization. We think this is crucial to fill that hole that is going to be left behind from vehicle imports that we saw from last year. So the government has already taken a few initiatives, such as introducing the GovPay and as well as the digital motor insurance card. And we are also hearing that the national digital ID will come into play in the third quarter of this year. And all these things will help us to close down the loopholes and widen the tax net, which will help us to fill in that hole that is left from vehicle imports. Then we also have the expenditure slowly starting to pick up. So as I have highlighted here, this is the capex spending of the government. And we are, from the research front, we are expecting 1 trillion rupees in terms of capex spending for 2026. Now, there's a question that a lot of people are going to pose here. The budget itself said capex spending for 1.3 trillion. Then the government again went to the parliament and got approved another 500 billion, raising up to 1.8 trillion. But we have predicted only 1 trillion here. The main reason is that although the government went to the parliament and got another 500 billion approved, we don't think that the government can spend this amount here. Mainly because of the fact that we are under IMF program, and in order to meet the primary surplus targets, the government has to stay within its boundaries. And that's why we think there's not a lot of room for capital spending. So what we are thinking right now is that government will focus on rebuilding the damaged infrastructure that were caused from DITWA, and may have to forego sometimes the new projects that will come on their way. So with revenue somewhat falling short, and with expenditure increasing, we are expecting budget deficit to slowly increase as well. So compared to last year, we are expecting for 2025 budget deficit will become around 4.1%. We are expecting this to increase to 5.9% in this year. And in the following year, we are expecting it to further increase 6.2 billion. So now let's look at the global front. So on the global front also, GDP is expected to slow down. And if you have been following the World Bank report that got released a couple of days ago, they're expecting GDP growth to be somewhere between 3.2% for the full year. And majority of the growth will be driven by the Asia-Pacific region, as you can see on the chart there. But most of the regions, such as Europe, is expected to have a very slow growth in 2026. So with this slow growth expectation, central banks around the world are taking a bit of aggressive steps where they are looking to cut down rates to propel their growth. And as you can what we have seen in the last year, where the Fed, they cut rates by twice last year by about 50 basis points, and now the rates are around the 4.25 to 4.5%. So discussing all of these, there's something that is lingering again in the global front. That is the rising political tensions in the world. So we have seen a few wars come up, and we have seen a few wars continuing. But we have seen a few wars getting halted as well. But these tensions are keeping slowly rising, and this is causing adverse pressure on the global GDP. So looking forward, before we move on to the next stage, where we are going to talk the recommendation, I want to put forward a few scenarios that we have shared with all of you a couple of years back. To be accurate, it's in August 2024, just before the elections. So at First Capital Research, we put forward these 4 scenarios. First scenario, the base case low scenario, the snail-paced stroll. The base case high scenario, that is the monorail dream. The super case scenario, the super grade highway. And the worst case scenario, the Sri Lankan pothole, where none of us want to be in that scenario. So out of these scenarios, we are thinking that Sri Lanka is progressing, and it's more, I think there's a chance that the first 2 scenarios is possible. So first 2 scenarios, the snail-paced stroll, we are having an outcome where GDP growth is between 3 to 4%. And interest rates can be on a possible rise, rising by about 100 to 250 basis points. Then debt to GDP is going to be a problem because of the slow growth, and GFN is expected to be underperformed. Then we have the scenario 2, which is the bit of an optimistic scenario, where we are thinking that GDP growth can be above 5% at least for the next few years. So in this scenario, we are thinking that interest rate will going to be stable, and the Sri Lanka is going to be outperforming both in terms of debt to GDP as well as gross financing need targets against the IMF. So analyzing these two scenarios further, we have put up a small chart where we are analyzing how the debt to GDP will be under these two scenarios. So the first scenario, the snail pace straw, we think GDP growth is going to be between 3 to 4%. So that is why when you see the debt to GDP chart slowly rising in line with the slow growth. And if you can see on the dotted line, dotted charts, that is the IMF projection where we need to be by the end of the year. So as you can see, there is clearly a gap that we can't achieve if we are growing at 3 to 4%. But however, if we step up our growth and we try to achieve the 5% plus growth, which is the optimum case, then we see something very positive. That is, debt to GDP slowly coming down, and it's going to be below the IMF targets, which is going to be very positive for the country. So on the backdrop of this, and considering the two potential scenarios, we think from the current trajectory that the Sri Lanka is currently on, that the snail pace straw or the base case low scenario is where the high probability lies, where we have given a 70% probability for this scenario. And the monorail dream is, that is the optimistic scenario, is beyond the 30%. Main reason why we are slightly tilting towards the base case low scenario is the lack of reform progress that we are seeing. And if we achieve the much needed reforms that we had to do in terms of the land, the entrepreneurial, then in terms of trade, I'm sure that we can unlock the second scenario, which is the base case high scenario, where we are having a 5+ GDP going forward. Then let me present the recommendations to you all. So first, on the recommendation on the bond market for 2026. So, for people who have been familiar with us, this is a system that we developed to assess the risk levels that is affecting the interest rates in the country. So here we have two set of criteria, the primary criteria as a secondary criteria, where primary criteria is having a bigger impact, while secondary criteria is having a slightly small impact. In terms of the primary criteria, we have foreign reserves, we have liquidity, we have private sector credit growth, we have foreign activity, and we have total credit. And in terms of secondary criteria, we have the rating changes, we have the rupee depreciation, we have the balance of trade and the balance of payment, and the business confidence. So all these factors combined and weighted, we are coming up with this fixed income health score. So as you can see, if you look at the period of between 2022, we see that a fixed income health score works because we saw interest rates going up when we hit the high risk territory. And with the economic recovery slowly, we have seen interest rates easing as well. And now something to mind is that we are seeing a bit of a change happening this year. That is, we are seeing the fixed income health score slowly dipping towards the medium low risk territory from 2025 December onwards. And I think we saw correctly that as well, with pressure coming and interest rates rising. So with that in mind, let's move forward. So before I move on to the fixed income recommendation where the yield curve is going to be, let me talk about policy rates. So in terms of policy rates, we are expecting policy rates to be broadly stable. Main reason why, we think that central bank may have to keep policy rates stable to reignite that growth that we are talking about. But there's also another thing that central bank can do, that is give a rate cut. So we are also not putting that out of the picture. We are giving a 30% probability that a rate cut can come our way. But broadly, we think policy rates are going to be stable. Although policy rates stay stable, we are expecting somewhat of a rise in the market interest rates, where, for instance, we are expecting market yield curve to rise up by between 50 to 100 basis points during the next 12 months. And if you can, from the screen here, you can see for December 2025, we are expecting the 1 year to be between 7.5 to 8.5, and this is expected to gradually rise to 8.5 to 9.5 by the end of this year. And on the 5-year bond, we are expecting December target was at 9.5 to 10.5. We have adjusted that slightly upward, and we are expecting 5-year bond to be between 10.5 to 11.5 by the end of this year. And in terms of the 10-year bond, it's a similar, we are having we are expecting a 100 basis point rise, where from the current 10 to 11%, we are expecting rise to 11 to 12%. So having discussed the bond view and the yield curve recommendation for 2026, let's move on to the banking rates or the AWPR. So as Akna correctly mentioned, we managed to correctly forecast where the AWPR is going to be broadly for the year of 2025. Now look at what's going to be happen in 2026. So in line with the pickup that we are going to have seen the market interest rates, we are thinking that the AWPR may see a rise as well, where AWPR is expected to be between 10 to 11% by end of December. In terms of exchange rate, last year we managed to predict correctly on the dot where the exchange rate is going to be. Exchange rate is going to be on the 310 level. So it broadly came in line. And for this year, we are expecting a similar view, where we are expecting somewhat of a 5% rupee depreciation in line with what we have seen in the past. So with that in mind, we are expecting the rupee to be between 320 to 330 by the end of this year. Then we have the last recommendation, that is the equity recommendation for 2026. To give you all the equity view, let me now invite my colleague Shahana to share the recommendation with you. So Shahana, over to you.
Thank you, Ranjan. Good evening, everyone. So as we look into the equity recommendations for 2026, the listed corporates are likely to record a 17% growth this year compared to the 25% growth recorded last year. So this moderation in earnings is attributed to a number of factors. Firstly, as Ranjan mentioned previously, the economy is likely to witness a moderation in growth this year. So this moderation in growth is likely to translate into lower business activity as well as lower factory utilization rates. Meanwhile, if we look at the business confidence index, the index dipped to a 12-month low in December 2025 and now indicates a subdued outlook. Along with that, we have seen the weakening currency that, together with the potential hike in electricity tariffs, is likely to impact business margins significantly. So overall, that is why we are looking at a moderation in terms of earnings growth. Moving on, we have seen the ASPI rising over 40% in 2025. Post-DITWA, we did see a slight dip in terms of the ASPI. However, it has since recovered and is now back at its 23,000 levels. So with that, the ASPI now trades in close proximity to its 18-year average PE of 12 times. However, looking at FCR's fair value estimates in terms of the ASPI, as you could see, we have taken a justified PE of 10 times, which is lower than the historical average of 12 times. The reason for this being the moderation in earnings that we are expecting, as well as the lower credit rating that Sri Lanka holds. So, keeping this in mind, this is what we are looking at, the final recommendation or our stance when it comes to equity. So we have advised our investors to cap equity allocations at 85% and maintain cash allocations at 15%. As the ASPI moves above the recommended range of 21,000 to 22,000, we are gradually requesting investors to reduce allocations or exposure towards equity. So with that, we come to the end of our presentation, and I would like to invite Ranjan back to the center stage. Thank you, Ranjan.
Thank you, Shana. So everyone, we have, as Shana mentioned, we have come to the end of the presentation. But before we wind down, let me highlight the quote that I started with. Austerity weakens growth, and weak growth increases the burden on debt. So we are right now at a crossroad right now. We are seeing a bit of a growth slowing down, and this is creating a bit of problems. We think the reforms is the way move forward. So with reforms getting forward, we think that it can reignite the growth that we are expecting to lose in the future. So hope we undertake that path and we progress on the reform front. And from with that, I'm sure we all can have a successful investment journey in 2026 as well. So thank you all, and thank you again.